Hello everyone, I hope you are having a good day. In this video, we will be discussing about the share capital and how the accounting of share capital is done. But before we dive into the word of share capital, we should must understand the distinction between a sole proprietor, between a partner, and between the investor. When you have one person running the business, that is the sole proprietor. When a group of individuals are coming together for running a business, that is a partnership. And an investor is someone who is investing his assets in a corporate in order to generate some returns. This investor is directly correlated with the company and is the stakeholder of a company. Now, what is a stakeholder? And a stakeholder is a person who have the keen interest in the workings of the company, and the workings of the companies affect his decisions. And a stakeholder can be anyone, a government, a person, a shareholder, an employee working, anybody who is related to that particular company is the stakeholder of that company. So, where there is a single person, that is a sole proprietor. Where there is two or more persons coming together to commence a business is known as a partnership. And where is a group of the persons coming together just for gaining some returns is known as the investor. The company's operations works on the capital which is bought by these investors. Company doesn't have the assets of its own, it completely depends upon the investors. If you are investing, then the company can run the business effectively. Or else. So that amount of money which we invest is raised through the share capital. Let us just break down this word share and capital. Your share in the capital of the company. Your share in the capital of the company. Now let us just look at the definition. So basically, a share capital is a fundamental aspect of the corporate finance and plays a crucial role in the operations and growth of the businesses. Understanding how to account for the share capital transactions is essential for any individual or organization which is involved in the financial management of a company. This presentation will provide a comprehensive overview of the share capital from its definition and its type to the accounting treatment of the various transactions, including the share issuance and the share buybacks. We'll learn about the term share issuance and share buybacks later in this course, but for now, we shall understand what is a company and what is a share capital and why the share capital decisions are really important for the financial management of a company. Now let us just dive into the video and explore the word share capital. Share capital, which is also known as the equity capital, represents the total value of the company's ownership that is divided into shares. For example, the company's ownership is rupees 500 lakhs. The company's ownership is rupees 500 lakhs. And it will be divided into the 500,000 shares, each share costing rupee 100, right? So it is just a denomination. These represent the ownership units of the company, with each share conferring the voting rights and the entitlement to the share of profits and assets. So what do these shares represent? They represent the ownership units. For example, if I am having the 10% of the share capital of the company, that means I am the 10% owner of the company. I have the right to the voting and also I am entitled for the profits and assets. Investors purchase the shares to acquire a portion of the ownership in the company, thereby contributing to the company's financial resources. The value of the share capital is crucial in determining the company's market capitalization and its overall financial health. Okay, so what does the value of the share capital do? The value of share capital is really crucial for determining the market capitalization. Market capitalization matlab what is the worth of your company in the market and what is the overall financial health. Now, how does the overall financial health count? Let us just understand one thing. What happens? You go out to buy a pair of shoes. A shoes is a investment which you are gonna keep for at least 1 year. Give or take. So you want to invest in good category. Now here you are investing in a company. When you are so cautious about buying a shoe that you are going to use for 1 year, then it is your life's wealth you are investing in somewhere. So if the company is not doing fine and if the overall financial health of the company is not good, your investment will degrade over time. So that is why the share capital identifies the financial health of the company. If the lot of investors are attracted towards a particular company, that means that particular company is likely doing well and you can invest, because basically an investor is very much afraid about the workings, about the things, and about his money. So he will definitely invest his money in something which will generate some returns for him. And that is why when the maximum people attract towards the particular company, that means that particular company is literally doing well. So that is how you identify the overall financial health of a company. Now let us just move ahead and talk about the ownership. The share capital represents the ownership structure of a company, with each share representing the proportionate ownership stake. This structure follows for the distribution of the ownership among the multiple individuals or the entities, providing opportunities for the investment and participation in the company's success. So what happens? Share capital represents the ownership structure. What is the owner? Who is the owner? With each share representing the proportionate ownership stake. For example, if I am buying 10% of the share capital, that means I am the owner of 10%. That means I am the owner of 10% of the company. Second is financing. The share capital serves as the primary source of the financing for the company. When the company issues the share capital, it raises funds from the investors who purchases these shares, providing the company with the financial resources for the expansion, operations, or research and development. See what happens if I am buying the shares of the company. That means in return, I am getting the share certificate and I am giving money to the company, right? That money will be utilized by the company for the various expansion projects for the various operations for the research and development purposes. That means with my money, the company is able to run its daily operations and expand. Third is the valuation. The value of the share capital reflects the market perception of the company's profitability and future prospects. The share price determined by the market forces indicates investors' confidence and serve as the key indicator of the company's financial performance. What happens? What is the value of your share capital? It reflects your perception and your profitability for the future prospects. If I am undervalued and if the valuation of my company, or I should say the market capitalization of my company, is not doing good, that means the investor will not be attracted towards my company because my capital valuation acts as the key indicator for the company financial performance. How the company's capital confidence increases? It increases when a lot of the individual will invest in my company. And when will they invest in my company? If they have the belief that in future this company is going to give them particular proper returns. If not that, why will they invest in your company? And if they will not invest in your company, that means they have a very low confidence in your company, and hence it will affect the financial performance of a. Fourth is the governance. Shareholders, as the owners of the company, have the right to participate in the corporate governance through the voting rights. These rights allow them to influence the company's direction and decision-making processes, ensuring the accountability and transparency. What happens? These shareholders, who are the owners of the company, they have the right to participate in the corporate governance through the voting rights. These rights allow them to influence the company's direction. They have the right to, who have the right? The owners. Who are the owners? The investors who have purchased your share capital. They have the right to participate in the corporate governance. They have the voting rights. They can participate in the AGM. Their vote can affect the decisions of the company. Okay, and hence they are showing the accountability and transparency. That means if the investor is really concerned about the company, that means the company is going to grow. Or else it will not grow if the investor is very much malleable and flexible regarding its investments. So governance, ownership, financing, and valuation. These four categories makes the share capital more effective and why it has to be the way it is. Moving ahead, let us just talk about the types of the share. Share capital can be classified into the various types based on its characteristics and the rights attached to the shares. These different types of the share capital cater to the various investor needs and preferences, offering at different levels of risk, return, and the voting rights. Share capital is divided into the various types based on its characteristics and the rights which is attached to the shares. Every share capital, every type of the share capital have its own unique rights. These different types of the share capital cater to the various investor needs and preferences, offering the different levels of the risk, return, and the voting rights. They are offering the different levels of the risk, return, and the voting rights. Now let us just talk about number one, that is the ordinary shares. Ordinary shares. These represent the most common type of the share capital. They provide holders with the voting rights and the right to receive the dividends subject to the company's financial performance. If the financial performance of the company is doing well, that means they will get the dividend or else. These are the owners. या जिसको हम बोलते हैं joint stock. This is what the joint stock. Let us just talk about the second category, that is the preference share. The preference share offer priority over the ordinary shares in receiving the dividends and the repayment in the case of the liquidation. They may or may not have the voting rights depending upon the specific terms of issuance. Preference shares offer the other priority over the ordinary shares. They get the dividends on the yearly basis and they also get the repayment in the case of the liquidation. They may or may not have the voting rights depending upon the specific terms of the issuance. It is told in the prospectus of the company if they are issuing the preference shares that they will have the voting rights or they will not have the voting rights. But they are preferred over the ordinary share capital in the case of the liquidation and when they are getting the dividends. But there is a key stake in this. In the case of the ordinary shares, the return is maximum. But in the case of the preference shares, the return is limited. They will get, but they will get the limited. Then is the third category, that is the redeemable shares. The redeemable shares gives the company the right to repurchase these shares at the predetermined price and time. This allows the flexibility in managing the company's capital structure and potentially reducing the outstanding shares. What happens? After a certain point of time, when the company's operations are running smoothly and the company is in no need to raise the share capital, in that case, the company can redeem its own shares. Redeem matlab they will buy back. They will take that share certificate from you. They will return your money to you. Okay. Now let us just move ahead and talk about what is the authorized share capital. So guys, the authorized share capital represents the maximum number of the shares that a company is legally permitted to issue. This is the cap ceiling. This is the cap ceiling, and it is the maximum number of the shares that a company can issue over its lifetime, as stipulated in the Articles of Association. An Article of Association is a set of rules that is formed when the company is registered or incorporated. They cannot be altered as per without the agreement of with the ROC, that is the registrar of the companies. This limit is a set at the time of the company's incorporation. Like I said, these limits are set at the time of the company's incorporation and they cannot be exceeded without amending the articles. If you are able to amend the articles, you wanted to raise the share capital, in that case, you can talk to the registrar of the companies and alter the AOAs of the company. But without that, you will not be able to do that. The authorized share capital acts as the ceiling on the company's share issuance, ensuring that it does not exceed its legal authority. For example, a company A got incorporated, and in the incorporation certificate it is written that the authorized share capital of the A Limited will be rupees 20 crores. That means in over the lifetime, that company is only able to get rupees 20 crores from the general public for the sake of the share capital. Okay. Now, legal limit. The authorized share capital represents the maximum number of the shares that the company can legally issue. It serves as a ceiling on the company's share issuance, ensuring compliance with the legal requirements. Articles of Association. What is AOA? The authorized share capital is specified in the company's Article of Association, a document that outlines the company's internal rules and regulations, including its capital structure. Any changes to the authorized share capital requires the amendments to the articles. Now, what is the company formation? The authorized share capital is determined at the time of the company's incorporation. It is the crucial aspect of the company's initial setup and represents its potential for the future growth and expansion through the share issuance. Okay, I hope these three words are clear to you. Now let us just move ahead and talk about the issued share capital. Now, issued share capital is a part of the authorized share capital. Now let us just understand it with the help of the whiteboard. Let me use a different pencil here, first of all, and I'm going to tell you. सबसे पहले हमने word पढ़ा. The first word that we heard was authorized. Okay. Authorized share capital is the share capital which a company can raise over its lifetime. Now, paid up share capital. It is a part of the authorized share capital. Part of the authorized share capital means authorized के कुछ part में से ही I will pay out. Okay. For that, the issued share capital. Before that comes the issued share capital. Authorized, issued, and then paid. The part of the authorized share capital which is issued to the general public is known as the issued share capital. The part of the issued share capital that is availed by the investors is known as the paid up share capital. Now let us just understand the concept in detail. Issued share capital represents the total number of the shares that a company has actually issued to the investors. It is the portion of the authorized share capital that has been allocated to the investors, creating a pool of the outstanding shares in the market. Issued share capital reflects the company's current ownership structure and the amount of the equity raised through the share issues. Okay. So issued share capital, it is the total number of the shares that the company has actually issued to the investors out of the authorized share capital. Authorized share capital represents the maximum number of the shares that the company can issue as is specified in the AOA. Issued share capital represents the number of the shares the company has actually issued to the investors. It is the portion of the authorized share capital that has been allocated and is in circulation. Okay. आर्टिकल्स ऑफ एसोसिएशन में क्या स्पेसिफाई है? ऑथराइज्ड शेयर कैपिटल स्पेसिफाइड है. ऑथराइज्ड शेयर कैपिटल क्या है? जो एक कंपनी लाइफ टाइम में अपनी कैपिटल को रेज कर सकती है. एंड इशूड शेयर कैपिटल क्या है? इट इज द पार्ट ऑफ द ऑथराइज्ड शेयर कैपिटल which is in the circulation. Outstanding shares. What are outstanding shares? It is issued shares that are currently held by the investors. These shares represent the actual ownership structure of the company, with each share owning a proportion to the issued shares. Okay. Now let us just move ahead and talk about the paid up share capital. Paid up share capital was a part of the issued share capital. So paid up share capital represents the portion of the issued share capital that has been fully paid by the investors. Okay, this amount has been fully paid by the investor. For example, I issued rupees 50 lakhs, and out of which 20 lakhs are completely paid off. That means that 20 lakhs is my paid up share capital. It reflects the actual cash received by the company from the investors for the issued shares. The paid up share capital indicates the company's financial strength and its ability to fund the operations and the growth initiatives. Okay, so now let us just talk about these types of the share capital. First of all is the issued share capital. The number of the shares that is issued to the investors out of authorized share capital. Second comes the paid up share capital. What is paid up share capital? It's the amount of the money which is received from the investors for the issued shares. Part of the issued shares, but which is received by the company. Unpaid share capital, it is a portion of the issued share capital which is not yet being received by the company from the investors. मतलब जितना पैसा इन्वेस्टर्स ने अपनी कंपनी को दे दिया है for the lieu of the share capital, that is the paid up share capital, and जितना पैसा नहीं दिया है, that is what the unpaid share capital. Now, how the accounting for the share capital transactions is done? Accounting for the share capital transactions involve the recording, issuance, repurchase, and the other related activities. These transactions have a significant impact on the company's financial statements, particularly in the balance sheet, which reflects the company's assets, liabilities, and equity. You must have heard this. Sorry. A equals L plus C, or commonly it is known as assets is equal to liabilities plus capital, which is the equation of the balance sheet. So accounting for share capital also follows the same concept. For example, share issuance. When the company issues new shares, it receives the cash from the investors and it increases its share capital. This transaction also increases the company's equity, reflecting the addition of the new equity. Okay. Then comes the share buyback. When the company repurchases its own shares from the existing investors, it reduces its outstanding shares. and the capital. This transaction also decreases the company's equity, reflecting the reduction in the ownership. Then is the dividend payments. The dividend payments to the shareholders represents the distribution of the company's profits. This transaction decreases the company's retained earnings and reduces its equity, reflecting the distribution of the profits to the owners. Then comes the stock splits and the reverse splits. The stock splits and the reverse splits involve adjusting the number of the outstanding shares without affecting the total value of the company's equity. These transactions can impact the share price and trading equity. Okay. So these are the four factors which is used and which affects the accounting for the share capital transactions. Let us just move ahead. Recording share issuance. The issuance of the new share is recorded in the company's accounting records using the general entry. We'll learn about the general entries. This entry reflects the increase in the cash received from the investors and the corresponding increase in the share capital. This journal entry typically includes a debit to the cash account and a credit to the share capital account. Okay. Now let us talk about what is the cash receipt. The company receives the cash from the investors for the newly issued shares. This increase in the cash is recorded as a debit to the cash. Then comes the share capital increase. The company's share capital increases to reflect the newly issued shares. This increase is recorded as a credit to the share capital account. Cash receipt बढ़ गया, मतलब कंपनी के पास कैश आ गया, ओके, एंड कैपिटल बढ़ गया. Okay, then what will be the impact on the balance sheet? The general entry increases both the company's assets and the equity share, maintaining the balance sheet equation, that is the assets is equal to liabilities plus capital, or in this case equity. In this case it is equity. Okay, that is how the recording is done. Basically the entry is bank account debit to share capital account. Bank debit what comes in, पैसा आया, बैंक और कैश कहाँ आया, share capital. So assets also increases and share capital also increases. That is how the assets is equal to liabilities. Capital equation is maintained. Let's just move ahead and talk about the accounting for the share buyback. When the company repurchases its own shares, it reduces the number of the outstanding shares and its share capital. This transaction involves paying cash to repurchase the shares and is recorded in the company's accounting records using the general entry. This general entry typically includes the debit to the treasury stock account and credit to the cash account. That means the treasury stock account debit to cash account is the entry. Now, how this entry works? The company records the repurchased shares in the treasury stock, which represents the company's own shares held in its treasury. कंपनी ने अपनी ट्रेजरी में से लोगों को शेयर इशू करे होंगे. अब जब कंपनी बायबैक कर रही है तो कहाँ आएंगे, उसी ट्रेजरी स्टॉक में तो आएंगे. तो जब ट्रेजरी स्टॉक में आए, ट्रेजरी स्टॉक अकाउंट डेबिट, डेबिट व्हाट कम्स इन, क्रेडिट व्हाट गोज आउट. डेबिट व्हाट कम्स इन, शेयर्स आ रहे हैं, कहाँ आ रहे हैं, ट्रेजरी स्टॉक अकाउंट में आ रहे हैं. क्या जा रहा है, कैश जा रहा है, तो दैट मीन्स टू कैश अकाउंट. Debit what comes in, credit what goes out. Treasury stock account comes in, to treasury stock account debit to where what is going out, cash is going out to cash account. Okay, then is the cash reduction. The company pays the cash to repurchase its own shares, resulting in a decrease in the cash balance. This reduction in the cash is recorded as a credit to the cash. Okay, what will be the equity impact? The repurchase of the shares reduces the company's share capital and equity, reflecting the reduction in the ownership and the outstanding shares. What happened? Ownership भी चली गई, outstanding shares भी कम हो गए. Okay, and company share capital will decrease. Why? Because they have buyback. जिनके पास ओनरशिप थी उनसे ओनरशिप छीन के अपने अकाउंट में रख ली, तो इसका मतलब ओनरशिप कम हो गई. सिंपल सी मैथमेटिक्स. Now, reporting share capital in the financial statements. How do you record your share capital in the financial statements? The share capital information is reported in the company's financial statement, specifically in the statement of the financial position, that is the balance sheet. Okay. The statement of the financial position provides a snapshot of the company's assets, liabilities, and equity at a specified point of time. मैं हर बारी बोलता हूँ that balance sheet is at a particular date. It is a specific point of time because it changes over time. Assets बढ़ गए, घट गए, liabilities बढ़ गई, घट गई, balance sheet change. So a balance sheet is something which is specified on a particular day or date. So statement of the financial position. The statement of the financial position, also known as the balance sheet, is a financial statement that represents the company's assets, liabilities, and equity at the specific point of time. Okay. So let us just talk about the equity section. The equity section of the balance sheet provides on the company's ownership structure and the various components of the equity, including the share capital, retained earnings, and the other equity items. Other equity items. Okay. Now this was it for this video. I hope you have understood the video. Now let us just go through a quick revision. We talked about what is the share capital, what is a company, what is the ownership, what is the partnership. Okay. What is the share capital? What are the factors that affect the share capital, ownership, financing, valuation, and governance? What are the types of the share capital? That is the ordinary share, preference share, and the redeemable share. What is the authorized share capital? What is the legal limit? What are the articles of association, and what is the company formation? And what is the issued share capital? How does the issued share capital is affected from the authorized share capital? What are the outstanding shares? What is the paid up share capital and what is the unpaid share capital? How the accounting for the share capital transaction is done? What is the share issuance? What is the share buyback? What are the dividend payments? What is the stock split and the reverse splits? And then what is the recording of the share issuance? And how the entry affects, how the general entries are done when you are doing the share issuance. Then how the general entry affects when you are doing the share buybacks. How do you report your share capital in your financial statements? That is the particularly in the balance sheet portion. Thank you so much.